Welcome back, everyone, to Vox Markets. My name is Paul, and I'm delighted again to be able to speak to Jamie Constable of Singers, a top-notch capital markets expert. So welcome, Jamie.
Hello, Paul. Great to see you again.
Yeah, well, the big sort of like macro issue du jour, certainly in our household, is that we've been struggling to get, my wife has anyway, carpets, curtains, cushions, electronics, even a collar for the cat, sort of stuff. But then it reached a real head this weekend or last weekend when I couldn't even get frozen veg down Tesco's. So we're obviously getting a lot of stock outs. But rather than concentrating on the problems, which stocks were going to be sort of like a lot of people brains? Which stocks do you think are going to sort of be beneficiaries of this, and how best should investors position their portfolios to take advantage?
Well, I think supply chain is obviously key for everybody, whether it's a supermarket company, whether it's a clothes retailer, whatever it might be. Supply chain is crucial. That's all the way from the containers coming in from the Far East or through to the logistics in the UK. So I think let's start a bit more closer to home. Let's look at the UK. There's businesses that, recent IPO on the market called Microlise. What do? They provide and make much more efficient the whole supply chain.
Wow.
Through information in the cab, through to route planning and intelligent route planning. And of course, what are we going to see? We're going to be seeing more HGV drivers. So that means they'll need more of their systems to actually drive it.
So basically, what they improve, but their software improves the efficiencies of the logistics. So they get more out of their drivers, improve sort of route densities and drop-off points, and they get more deliveries for less resource.
Exactly. They work more efficiently. They can check they're working more efficiently. Very importantly as well, of course, especially if there's going to be a lot of new truck drivers coming through as they train more. They have cameras in the cab, and they monitor how they drive to make sure they're driving safely, because with a lot more on the road or new drivers on the road, you want to make sure that you, as a company, that you're performing safely, because the last thing you want is some scandal that your drivers are all flipping, I don't know, getting their lorries stuck under a bridge. That happened recently, didn't it, somewhere, or things like that. So yeah, it's a must-have really for the logistics companies. And
it must be, if it's more software related, it must be pretty scalable as well. I mean, it's one of those services that can be lifted and shifted, and it's sort of like it isn't bespoke specifically to a customer. It might be a bit tailored, but essentially it's a sort of like a high gross margin type, high EBITDA type margin business, I guess.
Well, there is some hardware as well. Obviously, if you put in a camera in there and then tracking, but someone like JCB, they do it at the factory. It's an OEM, it's a pit. So but obviously once you're in there, and it is all in the cloud, obviously, the software is all in the cloud, the route planning is all done in the cloud. So yeah, totally scalable from that point.
And what's the recurring revenues on that one? I guess it's pretty high.
Well, it is, because once you've got it, you don't want to lose it.
Yeah, exactly. Particularly if it's giving you huge benefits.
Yeah. So that's one. They're expanding overseas as well. And interestingly, and what I really like is it's their customers taking them overseas. It's always the best way of going overseas, rather than having to go into a market and start in a virgin market. Being taken by your customers obviously covers your overhead as you do it. So that's one that benefits there. Other ones are the logistics companies themselves, of course. I mean, you've got the star child in the sector in Clipper. Rated as such as the star child. So actually, I think for me, I'd like to look lower down to the ones that are on the lower ratings. I think we might have mentioned some of these before, but you've got Wincanton. Yeah,
I just saw, actually. I just doing the numbers. Clipper rates is about 30 times PE, isn't it?
Yeah.
It's not cheap.
Not cheap, but it's a growth stock.
Okay, gotcha.
And most of its business is online with lots of online retailers as well. So obviously it's in the real sweet spot from that point of view. Yeah. But that's where Wincanton's going as well. And you're paying 11 times PE for that. So what's the difference? There is a difference, obviously. Yeah. Otherwise they wouldn't be up there. But Wincanton, they did a small acquisition, a bolt-on acquisition the other day, adding customers like Brewdog, etc., and stuff like that. They're growing that shared location. Online retailers and grow with them as they grow. So 11 times for Wincanton, very cheap.
I guess COVID has meant we've got that sort of acceleration of all things e-fulfillment and e-commerce, and so the overall logistics market has just expanded hugely in 18 months, and probably expanded more in 18 months than it would have done in 5 years.
The pandemic has accelerated digitization and digitization in all forms, isn't it, really? It's not just digitization as in, I don't know, tech in the cloud or something like that. It's digitization full stop.
And how do you choose between something like Wincanton and DX and the Royal Mail and, I don't know, DHL and all these kind of other logistics companies?
I think, to be fair, they will all benefit to varying degrees. I think you look for the ones where you've got to be comfortable with the management. That's your first. You've got to be in mid and small caps. You've got to be comfortable to back the management. So in Wincanton, we are. DX is quite an interesting point on this one, because to be fair, I would never have looked at DX. It's been a failed company twice. It was a public company. It went private. It came back. It profit warned. Why do you back DX now? Because the guy who's leading DX is logistics through and through. He knows his whole career has been logistics, and that's what. Is
this Lloyd Dunn? Is it the CEO?
It is. He's a real character, great guy, but it's logistics through and through.
He isn't your dad, is he, by any chance?
No,
a bit like you.
No. But so that's why I would back that one. And again, that's cheap. I mean, if you look at the share price, it's come up a long way, but it's come up from a position where it was.
Yeah, it's 14 times, isn't it? I think
no one would have looked at it, you see. So plenty more to go for there.
Well, what I quite like about those particular picks further down the food chain, there's still lots of self-help they can do, isn't it, in terms of margin? Because when you look at the EBITDA margins, they're sort of high single digits, whereas international peers tend to be sort of 10 to 15%, rather than sort of like 8 or 9%. So there must be still, particularly if they utilize Microlise software, then you're going to be able to presumably increase those margins. There must be some self-help there.
Well, there is definitely with DX. There's a lot more to go for on the margin there. I think at the operating level, they reckon they can get to it's higher at EBITDA, but at the operating level, they can probably conceivably double from here over the medium term as well. Wincanton's more about the growth of the business and growing with the whole logistics sector and delivery of that. And importantly, we should say here, because some people might ask the question quite correctly, what about, can you get the drivers to be able to drive? Well, they have their own their programs, but also, of course, the bigger players, the ones that do better than the private players anyway, the public ones. And in terms of if they have to increase wages for their drivers, Wincanton, for example, 70% of their business is open book. So you just basically pass it on. And as we know on prices at the moment, I mean, everybody is raising prices. And when everybody's raising prices, everyone expects prices to go up. So it's actually a lot easier to raise them. And I think maybe just making a point then on wages as well. I mean, every company I've seen in the last 2 weeks, as we're in results season now, they're all saying they expect wages to rise.
Not at Vox, they're not. Not at Vox Markets, I can guarantee it.
Not at Singers either. But everybody's expecting wages to rise. And if management are saying that, well, they're going to rise, aren't they? Yeah. So wages are going to go up. Look at Restaurant Group. They see in 20...
So do you still think this inflation story is transitory then? Because you said to me last time, when I tried to put you on the spot, you're going to get 2% CPI at the end of 2022.
That's more of a top-down type view, in that I think it depends what they do.
Oh, you're saying as though you're less sure now.
I don't think it's transitory. I think at the very minimum, it's higher for longer. The big question is, will it get into wages? Because it's wages that drive it. When you get into that wage spiral, then that's what drives inflation. The picture is looking much more likely that it's going to get into wages now. And then we could well see higher for longer. In terms of inflation, and it could be higher for longer. So
I must admit, I've heard the argument saying we're going to get higher wages, but it's going to be a one-time reset rather than an ongoing self-fulfilling. And if it's a one-time reset, you do go to your 2% at the end of 2022. So I'm only pulling your leg a bit here, Jay.
I know. It's a very difficult. It's the $1 million question at the moment for the market, to be honest. I mean, the Merrill Lynch survey's come out, or Bank of America survey, it's called now, and I think about 70% of fund managers think that inflation is transitory. So that is the consensus view, that it's going to be transitory. So if it's not, then that will be a challenge for the market to get through that.
Yeah, I must admit, the one on the whole on the logistics and the supply chain that I like, which is very much like Microlise, but operates in a sort of like a deep vertical expertise, which I think actually Singers has just initiated. It's called Eleco, which is one of the UK sort of like build tech software. Operating margins about 9%. Released results actually only yesterday. And why I particularly like it in terms of supply chain, it supplies its software to three main types of customer, all actually overlapping, but the sort of principal one, which is power project, allows contractors and builders to much more efficiently and reduce their costs of that whole sort of site manager. If you put yourself under the hard hat on and you've got 300 houses on a site to do, and you've got so many different moving parts in terms of cement, building products, doors, footings, windows, all that kind of stuff, plus your labour and your delivery all on one. You've got a lot of parts that could actually, damage the critical path if you want to fill that site.
And that's even more important, Paul. It's even more important now. I mean, we have two house builders, cracking companies that we're broker to, Springfield Properties and MJ Gleeson.
Yes.
They will say to you that because of the supply chain constraints that you've got in the industries at the moment, they're actually doing fine, they're managing it, but they'll have to move stuff between sites because they don't get the delivery. Well, what Eleco's software there is obviously crucial for doing stuff like that.
Yeah, well, that's their flagship. And then they've got actually the two other areas are even going faster. They've got AI visualization software that I told you my wife has been trying to get some carpets and curtains and stuff like that. Well, she actually used in the kitchen, she's bought for the first time ever, totally online, some Cardine tiles. And the Cardine software allows you to shift and lift pictures of their tiles in really good 3D graphics onto your existing kitchen without you can't see the difference. So she's gone from being in a showroom purchaser for the whole of her life now to fully online. So she's kitted out the whole of the kitchen online using Cardine software that's powered by Eleco. It's generated. So that's going great, guns. And then the stuff actually which is going really, really even faster than that. Their third little leg is basically asset management, which helps. And this comes back to your point in terms of getting better efficiency out of manufacturers. I think people like Wren Kitchens, they've got a case study on their website, but it basically allows them to get more productivity, higher output for less labour and less raw materials from their existing assets in their factory. It's benefiting from that whole move to smart factories. So they've got three real sort of like massive growth drivers, and that's a whole, just boosted by the supply chain. So I know you guys, I think you've got a target price of 160 compared to the current shares. I think it's 121 at the moment, but I must admit I can't see it valued anything less than 150. And it's a cracking little business that people should have a look for. Now, the other thing, we'll move on from there because I know we've covered that one in detail. But it's fascinating. But it's fascinating. But I'm going to test you again, okay, for a bit of stock picking. All right. Now, the other big news, which didn't actually get much airplay last week, but it was pretty big, was that the government announced that it was actually going to remove the sort of one-off or the temporary creditor protection for companies. And that means that basically insolvency cases can now go to court for medium and large corporates. Who's going to be the winners in that area? Because people have really ignored it. It didn't get any news flow last week at all, but it's really going to put a rocket booster up that whole industry.
It's interesting, isn't it? Because the likes of Begbies, Traylor and FRP, they've been doing quite well, to be perfectly honest, but that's without any insolvencies coming through, because basically you haven't been able to, you've been free, you're not been allowed, the government have not allowed any companies to go bust. Yeah. So what we're seeing now is that, of course, people are going to have to start paying their interest on the various government scheme loans that were given out through the pandemic. And that really focuses the attention for people. So I think, we could well see, number one, creditors going after companies, but number two, people kind of saying, well, hang on, I've got to start paying my interest on this now. Can I do that? Do I really want to keep doing this? And of course, it's been a little bit cynical. What have we seen in the building industry for years is you do a project, you finish it, you wind the company up and you start again with a new company.
Yeah, and also because of that sort of like that period of sort of, you know, forbearance over the last 18 months, you've got this huge backlog of cases. And also, I don't know if you saw it in the news about 12 months ago, there was a lot of sort of like questioning and whether some of these loans which had been taken, particularly sort of bounce back and all these, were actually genuine ones or they're actually in fraud. So what you've got is basically not only you've got a lot of companies went into the pandemic pretty weak and just been limping along, and therefore you've got that natural sort of like putting them into insolvency, but you've probably got a lot of, I mean, who knows, but we'll wait and see, but, you know, possible director malfeasance in terms of, you know, wrongdoing.
I think the whole legal profession is a new area to the stock market. So these companies, the market's it's been finding its way a little bit with these companies over the past few years since they've IPO'd. And I think, to be honest, there's going to be some new ones coming to the market in due course as well. But it's an area we cover. I'll just finish off on the whole kind of insolvency side. Our favourite there out of Begbies and FRP is FRP. Why do we like FRP? Because it's higher up the FRP advisory is higher up the value chain. We think we really like that stock. We think there's a lot more to go for. They're doing M&A as well. They've improved their position in the market through the pandemic. So that's a stock that we'd look at for that.
And how scalable is HR? Is it
scalable business? You add people, don't you? But how do you help to scale it? Well, you buy in smaller practices that bring you either geographic expansion or maybe into a different area of the market, maybe a new vertical or something like that.
I must admit, on that one, actually, with regards to the actual rating, it's only on about 16, 17 times PE on essentially pretty conservative estimates. If we're right and we get a big surge in insolvency cases and restructuring and all that kind of stuff, then that PE is probably going to halve.
The business can come back very quickly there.
Yeah.
And then if we flip onto the general kind of legal firms, and I know you talked then about dispute resolution, you've got the poster child who actually had numbers today, to be perfectly honest, in Keystone Law at the top of the sector. It's a platform play. We all know how the platform plays. And it's kind of benefiting from this kind of, what's been accelerated by the pandemic. People want to work at home and stuff, because if you're a kind of magic circle lawyer, you're working 6 days a week, but you actually want to move to 4 days a week, you can move on to the Keystone Law platform, and wonderful, you can keep your business going and be very happy. But to be fair with that, it's a great company, really like it, but a lot of it's in the rating. I
do love the name, isn't it? I mean, basically insolvency, Keystone Cops. I mean, it has a fantastic analogy.
But it's a great company, Keystone. But I'd kind of go back to a couple of other companies. In the kind of legal firm to the kind of mid-cap, mid SME kind of UK, you've got Gateley. Why is Gateley really good? Well, basically, this business has grown every year since it started, and including through the financial crisis and including through the pandemic. And there's not many companies you can say that out there. But also, it's got the largest M&A practice in the UK by number of deals done. So not by, it's not doing the 20 billion pound deals. By number of deals done, it's the largest. And we all know what's happening in M&A at the moment, both in the private market and the public markets. And it's heavily exposed as well to property markets in their widest sense, whether it's commercial or residential. They don't do the you and me buying the house on the final end of the chain there. They do the other stuff. And what are the house builders doing? They're increasing volumes. They need more land. That's all great news for Gateley. And they're expanding the group to make it more of a general services to the corporate group, with kind of advice like HR and psychiatric help even, and stuff like that. So profiling and things like that. So when you see change, and what are we seeing in the economy at the moment? God, we're seeing change, aren't we? And whether it can even be tax, it can be employment, everything. Where's the first place a company needs to go? It's lawyer.
Yeah, go to a lawyer. I totally agree.
It goes to a lawyer. And within it, they've got disputes resolution as well, of course, and they've got litigation business. So that's one I would look at. And another one would be RBG. It used to be called Rosenblatt. It's RBG. They got their legal practice, which is pure what you're talking about. It's dispute resolution. Rosenblatt, people probably know the name. So what are we going to see now? People can't supply the goods in time. Whatever happens, they're not supplying under contract. You get disputes, don't you? So dispute resolution there is going to be good. They've got an M&A practice, which they bought. Slightly unfortunate on the timing. They bought it going into the pandemic, but actually now it's coming back really strongly. So they did 8 cases in the first half, and they've got a pipeline of 35 in terms of M&A deals.
Wow.
So, and then you've also got their litigation funding business there, which is more split out than it would be within Gateley. They fund litigation, and they're very choosy on what they do. But again, you've probably got that. It's a bit kind of flippant to say it's thrown in for nothing, but you know what I mean. You've got that business there as well. And I think you got your own favourite in the sector as well, haven't you, I think?
Yeah, I mean, my one is actually the UK's go-to provider for sort of insolvency litigation funding. It's a company called Manolete. I think that's ticker MANO. And they've been obviously hit because of the creditor protection over the last 18 months by the government, which has reduced the number of insolvencies. Not so much on the completions. They've gone gangbuster on the old cases they had. But it's stopped the inflow of new cases, but also if they are actually in the pipeline, the first 12 months, getting them to court and actually getting them through the court. And that first 12 months is important because that's when once they're through the court case, then they can start realising revenues. But essentially, I mean, they own this particular market. I mean, their market share in this third-party funding is more than 50%. It's a real specialist niche. And they've got those experts on board. And I'll just give you a sort of like this is the kind of thing they do. They'd approach a big insolvency practitioner or even a small one who might want to basically not take all the balance sheet risk of funding this thing through. And it might take to recover all the monies from a case. It might take sort of like 3.5 years or 4 years. So it's quite a big sort of like financial commitment for the insolvency practitioners, or even the likes of sort of like the big accountancy firms, for large cases. And they've got the in-house expertise. They buy those cases rather than rely on somebody else to resolve them because they've got that in-house expertise. And I'll tell you how good these guys are. They've been the top insolvency funding litigation provider in the ratings for 4 out of the last 5 years. They're the only one currently in the chambers in London, down the Temple. They have this rating, and they're the only one in band 1, which is the top band, and there's nobody else there. So they are by far and away the go-to provider for these types of services. And where they really win, this is what I like, is that not only do they provide a fantastic service for the actual the IP, but because of the history they've got a fantastic database of the previous cases that then they can mine and use as best practice. And that's important when it comes to pricing risk, because what you've got coming out of this pandemic is 2 things. One, an absolute ginormous tsunami of cases coming through of the backlog. That will give you not only high demand going forward, but also a lot of low-hanging fruit, because there's a lot of cases which actually an insolvency practitioner doesn't want to take on its books because it can't price the risk properly. But actually, given the experience of these guys, it will just shell them out like peas. Just bang, bang, bang. Now, their results were obviously impacted last year. They only got about 7 million of EBIT or something like that. But they could easily double that on a steady state basis. You put a 13, 14 times multiple, you get a share price or a valuation of over £4 compared to their valuation, their shares at the moment, which is about £2.80. The actual corporate broker are on about £4.20. And I still think that is conservative. And, when you look at that sort of the wave of insolvencies that we still need to get into, and it's a go-to, and that's why I particularly like it. It's so specialist. It effectively, it can not controls, but it is such a dominant go-to player. It's a big market, I think, isn't it? I think
these companies are all going to benefit if we do see that.
Well, it is interesting you say that. It's a big £1 billion market, no doubt about it. Yeah. But very few of it is actually third-party funded or bought, and then actually resolved. And that's growing rapidly, and that's the specialism that they do. And you've got to remember, it's not easy to become an insolvency practitioner.
Oh no.
Yeah. So actually, the barriers to entry for this thing are really quite large.
That's
and the other thing, it's not without risk. So people who go in there and become an insolvency practitioner, if you mess up, you're personally liable for it. So there's actually this is not going to be AI because there's a lot of human judgment associated with it. So that's why I love it. I mean, I think it's, what was actually, I'll tell you what actually pulled my, sort of like piqued my interest a few months back. My eldest daughter works for a big accountancy firm in business recovery. She only moved over there at the start of the year. It's been pretty quiet. Well, forget that. It is gangbuster now. Started in July, pick it up. August should have been quiet. Sorry, it wasn't that. September, it's 7 days a week, 24 hours a day. And their business, Manolete, sees the real pickup of that 2 to 3 months later. So I think what will happen is, in terms of news flow, they're coming out with some, I think it is trading statements in the next month or so like that. But I think in terms of news flow, towards the end of their fiscal year, which is March 2022, that's when you'll really see some good news coming through. But anyway, that's what I like. So we'll wait and see. Okay, brilliant. Well, I look forward to picking your brains on 2 more key areas. I love that.
Maybe we'll do a little bit more economics next time. We'll see what happens. But I think
okay. Just on
really what's happening, I think it's playing out how we thought in the short term. So there's not much more to be said on it. But the one point I'd leave everyone with is that, pricing power is absolutely key, and make sure and ask everybody what's happening with their costs next year. Because it's not just wages. I mean, Restaurant Group came out yesterday. They see utility prices going up 50% next year. So just bear that in mind.
Wow.
And you'll see it in your home. Well, obviously in home energy consumer, we've got protection because you've got the cap. But obviously industries don't have a cap. So just keep an eye on that. All right.
Okay, look forward to it, Jamie.
Okay, Paul.
Speak
cheers.
next month.
Cheers.
Thank you. Bye.
Bye.